All right, let's dive into one of those classic Wall Street puzzles. You've got a company, in this case Ashland, that misses its earnings targets. On paper, that looks bad, right? But then the stock rallies, hard. So what's going on? How did a report that seemed like a failure actually convince the market that it was a win? We're going to break it all down.
So here's how we're going to tackle this. First, we'll lay out the paradox itself, the miss versus the rally. Then, we're going to peel back the onion and look behind the headline numbers to see what investors really saw. After that, we'll get into the company's big strategic shift, check out their forecasts, and then we'll wrap it all up with our own rating on the stock.
Okay, so this is where the mystery really starts. You've got these two pieces of data from Ashland third quarter report, and at first glance, they just do not make any sense together. So check this out. On one side, you have the miss. Their adjusted earnings per share came in at $1.04, a full 20 cents below what the street was hoping for. And revenue? $463 million. That was short by more than $13 million. Kind of disappointing, you'd think. But then, look at the market's reaction. The stock popped 5.6% on the day of the announcement, and the trading volume was 2.5 times the daily average. So what did the market see that the headlines completely missed?
To solve this paradox, we have to do what savvy investors do. We have to ignore the surface-level noise and dig deeper to find the real signal that was buried in that report. Now, if you looked at the official, by-the-book GAAP earnings, things looked even more terrifying. A loss of over $16 per share. I mean, that's the kind of number that causes a panic sell-off. But in this case, it was almost entirely noise.
So what was behind that massive loss? It was this thing called a goodwill impairment. It sounds awful, but here's the deal. It was a $706 million non-cash charge. It's really just an accounting rule playing out. The most important thing to understand is that this did not affect the company's cash pile, it didn't hurt their day-to-day business, nothing. The market knew this was just accounting paperwork, not a real problem with the business itself. So if that massive loss didn't matter, what did investors care about? This number. This is the hero of the story. Ashland's cash flow conversion rate was nearly 100%. That means for every single dollar of adjusted profit they said they made, they generated almost a full dollar of actual real cash. In investing, cash is king, and this is a massive signal of real financial health and discipline. The accounting might have looked messy, but the cash story was crystal clear, and it was incredibly strong.
And you know, that fantastic cash flow wasn't some lucky accident. Nope. It was the direct result of a very clear, very decisive strategic plan that management has been executing. And that's what investors were really rewarding. This wasn't a company sitting back and taking bad news. This was a company actively forging its own, better future.
The plan really has two main parts. First up, portfolio optimization. In plain English, that means they've been methodically getting rid of businesses that weren't making much money so they can focus on the stuff they're really good at. Second, manufacturing network optimization. This is a huge $60 million project to make their factories more efficient and way less expensive to operate.
And this isn't just some PowerPoint fantasy. They're actually doing it. You want to know a secret about that revenue miss we talked about? Turns out, about $53 million of it was deliberate. It was a direct result of them cutting out those weaker businesses. Management says the company is now more focused on better markets. Plus, their restructuring is actually ahead of schedule, with real cost savings about to hit the bottom line. This is exactly the kind of execution Wall Street loves to see.
So after laying out this solid strategy, management then gave its forecast for the rest of the year. And you know what? Instead of scaring people, it actually made them feel even more confident. They actually narrowed their guidance for both sales and profits. Now, that could easily be seen as a negative, right? But the key takeaway here is totally different. By tightening the range, management was basically saying, we have a really good handle on our business, and we're being realistic about the current market. It comes across as discipline, not distress. And hey, don't just take my word for it. The CEO, Guillermo Novo, said it himself. He called it a prudent stance that shows off the durability of their business. The message couldn't be clearer. We get that things are a bit tough out there, but our business is built to handle it, our plan is working, and we're not going to overpromise and underdeliver. So let's put it all together. You've got strong cash flow, you've got a smart strategic pivot, and you've got realistic, credible guidance. So what's our final verdict on Ashland? What's the call? Based on everything we've seen, our rating for Ashland is outperform.
And here's why. That cash generation is super resilient, which gives them a nice safety net. The big, messy portfolio cleanup is now done, which takes a huge question mark off the table for investors. There are major cost savings that are basically locked in and ready to boost profits next year. And, most importantly, you've got a clear plan being run by a disciplined team. The market is finally catching on and is betting on this bigger story of cash and strategy, instead of getting hung up on some short-term weakness.
So really, the takeaway from Ashland's paradox is that in a complicated market, things like cash flow and a clear strategy can speak way louder than a simple headline earnings number. It's a fantastic reminder to always look under the hood. And of course, this is for informational purposes only and is not financial advice.